Hello and a warm welcome to Talking Stocks. I'm Pupuletu Cele. In studio with me, I'm joined by Peter Armitage and Sean Ashton, both from Anchor Capital. Now today we're talking MTN, a South African-based multinational mobile telecommunications company with operations in 22 countries across the continent and the Middle East. As of the 30th of April 2015, MTN had more than 220 million subscribers. So we also are joined by our studio audience today who will be participating in this conversation, some of whom are wearing yellow, some of whom might be MTN subscribers. But the big question is, are they shareholders and will they change their decisions after this evening's conversation? But Pete and Sean, good to have you with us as always. MTN, clearly, as we've highlighted, a juggernaut of a company with significant operations, but a lot of the income still coming from SA and Nigeria, right, Sean?
I think it's quite diversified. I think South Africa is actually one of the lesser important of the markets that they operate in. It's about a quarter of profits. And really Nigeria has grown to be an absolute beast. There's about 63 million subscribers there, which is more than the population of South Africa. Obviously Nigeria is a much bigger country from a population point of view, but that's roughly 50% of the profit pool of MTN. So really the driver of growth or otherwise going forward.
Maybe if we get a quick recap of this company. Obviously entered as a mobile telecommunications firm, stirred up the market and added competition for Vodacom, but have they managed to innovate and change over the years since the initial launch back in the early 90s?
I think one of the things about cellular operators is ultimately what they're doing is they're putting down huge capex on the ground and then they've got to fill that up with subscribers. I think if you go back to the early days of cellular telephony, they've valued at very high multiples. And there was an expectation, and my feeling, I remember being an MTN analyst many, many years ago, that if they owned the cell phone in your pocket, they could communicate with you. But I think one of the disappointments with cellular companies is they haven't actually been able to capture anything other than the airtime. They would defend that vigorously, but I'm saying from a material perspective, effectively they're making their money out of selling you bandwidth, which is used for voice or used for data. And other companies have come in and used the instrument in your pocket to make good money out of it. And they've made attempts to do things like mobile banking and the like. They've had some success. I think their biggest country with that is Uganda. But in South Africa, that's been a bit of a dead duck. So what you're sitting with is a company with, as we've seen, over 220 million subscribers. But ultimately that it's mature now, and the revenue per subscriber is continually coming down, and you've got competitors all competing for that same airtime. And ultimately they're selling a commodity. The challenge with these businesses has been to move out of that and to sell something other and to add value, but the business has never really been able to, and it's not just MTN, their competitors as well, have never really been able to do meaningfully add anything other than selling you the airtime.
And clearly data is clearly the new story now, where that's where they're looking to derive growth from. And maybe if we can explore that theme before we get into the geographical split of the income and where that's coming from, Sean.
Absolutely, and I think that's where a lot of their network capex is aimed at, is trying to drive more data revenue growth. And it's now about 22% of revenue. Significant growth in that line item. I think it was up about 20 to 25% in the last financial results. But when you take into account that still 80% of your revenue is essentially voice and text messages, which are coming under pressure from the likes of WhatsApp, which is effectively cutting out that SMS margin for many of these networks, you're still having revenues going backwards. So despite the fact that subscribers are growing dramatically and you're getting this very strong data growth, it's not important enough in their lives yet to actually be a driver of overall growth. So despite the fact that you've got 20 to 25% growth in data, you still have a picture of single-digit overall revenue declines where your costs are still growing ahead of that. And importantly, your capex is still growing to try and build out that data revenue. So, I mean, I see a picture of falling margins for this business overall, together with relatively high capital requirements. And they're now essentially paying out all of their free cash flows in the form of capex and dividends. So it's not clear exactly that capex is actually going to drive top line growth. So they're in a bit of a tricky spot.
And Gugu, an amazing fact is that 22% growth in data, the mix of that is close to a 90% increase in amount of data, but over a 60% decrease in price. So the amount of data was higher than the price, you still had a net positive. But you're sitting selling a product that you're selling for 70% less than you were the year before.
Exactly.
And by the way, if you haven't, you must go and have a look at your data contracts. The other day I went and looked in a competitor network, and I had an old contract where I was paying 4 times more than I needed to. And I think there's still some of that sitting in the system.
Geesh, well, clearly the environment is changing where the consumer is king in making their decisions. But maybe if we can stick to that theme when it comes to competition as well as the regulatory environment. When we look at South Africa, and the graph will come on screen shortly where we look at the earnings, it does seem as though it's taken a bit of a tumble there that you alluded to, right, Sean?
Sure. Yeah, and I think the picture that you're showing up on the screen there is exactly the picture of all of these mobile networks once they've reached maturity. Is that you've had quite strong growth in subscriber numbers, significant growth, but at the same time, average revenue per user is declining. In the case of Nigeria, it was something of the order of $18. If you look back 8 or 9 years ago, it's now $6. It's a third. The revenue per user is a third of what it was 8 or 9 years ago, and continuing to fall. So I think as you add, once you've penetrated a market and you're adding incremental subscribers, you've monetized all of the good subscribers. And when I say good subscribers, I mean highly profitable, wealthy individuals. And the incremental subscribers that are coming on are at lower and lower average revenue.
The only subscribers that are left are really the dregs from a business point of view. So if you look at the average, is 60 or 70 rand a month. If you picture how much you spend on your cell phone, that's the average. So there's a lot of guys spending 1,000, 2,000, 3,000. That means there's a lot of guys also spending literally 5 or 10 rand a month on their cell phones.
Which is rather marginal. And the impact there on the EBITDA margins clearly comes under pressure like you alluded to.
Sure.
Maybe if you can walk us through that theme again and the potential threat on the company going forward.
Absolutely. So I think that if you look at this business, half of profits coming from Nigeria. Nigeria was a business making 63% EBITDA margins. At the same time now you've got revenues coming under pressure at the same time that costs are going up. So that's now down into the 50s, and we would argue that as more and more competition comes into that market, you must understand that for a mobile networks company to be making a 60% EBITDA margin is extremely high. So you've got a very large profit pool in a market that's quite well penetrated now, but there's more competition coming in. So they were obviously one of the leaders at the inception of mobile networks in the country, but we would argue that profit pool is probably something that's going to be quite tough to defend.
And Gugu, when you're the big giants, when you're the bully in the playground, the teacher's going to have a go at you. And that's what's happening in South Africa, Nigeria, all the big countries. It's kind of fashionable for governments to put pressure on cell phone networks to try and bring down tariffs, to try and bring down margins. So you're constantly seeing, and we don't know what the future holds, but what you know for certain is that regulators will regulate more and make it a little bit more difficult. So you've constantly got that threat. It's kind of a bit of a dark cloud.
Even though the diversification is clearly what we like about MTN, given the spread that it has on the continent and the Middle East.
Diversification
it's a threat,
by
right?
country, but they're still big in a country. So that country,
exactly.
Nigeria will regulate against MTN in Nigeria.
Exactly.
In South Africa, we've already seen that pressure come through.
And that's the threat that I wanted to allude to when it comes to the currency crosses, because we know Nigeria's currency has also depreciated quite significantly against the US dollar, as a result impacting on MTN's earnings. And again, oil price also plays a bit of an issue there too.
You've already felt quite a lot of that. So the Nigerian naira has fallen in value quite significantly against the US dollar and the rand. So, I mean, that may be forming a bit of a low base for them, but it's not obvious to me that it necessarily has to strengthen significantly. So if oil prices remain low, I mean, you may well find that Nigeria continues with a balance of payments problem, and that may well result in further currency weakness, which ultimately is going to be a headwind to half of your earnings stream in the form of Nigeria, in the form of MTN.
Now, this is a stock that was well above 200 Rand just over a year ago. It has pulled back ever so slightly. If we look at the metrics and the valuation of it, though, does it compare favorably against its counterparts?
So I think unusually in the context of the South African market now, this is one of the few shares which is actually cheaper than its long-term average now. You've got the business trading at a forward 13-odd PE. It's gotten back to more or less its 10-year average multiple, which is not something we can say for a lot of shares out there, and this is obviously a big stock in the context of the JSE. So I think there is an argument to say that some of the price weakness perhaps is overdone in the short term, but I'm of the opinion that if there's any meaningful strength from these levels, that's rather an opportunity to take profits off a low base. This is not really a business I'd want to be owning longer term. I think it's become a bit of a bond with growth in the sense that they're paying out pretty much all of their earnings as a dividend. They've then got quite a heavy capex requirement to drive data growth. And I'm not convinced that that's going to drive overall revenue and profit growth. That's all that meaningful compared to some other companies out there. So to my mind, although you're getting a 7% forward dividend yield, which is quite high, the ability of this business to generate double-digit profit growth is not very great, I would say. So
not even with the prospects maybe opening up in Iran as well, with the US considering letting go of those sanctions there?
I don't think it's going to be that significant to move the needle overall, especially in the context that you've got. So it's a positive, yes, but you've still got Nigeria that, to my mind, is going to struggle, and South Africa is a highly penetrated market.
Sean, let's get your view on MTN, buy, hold or sell.
So for me, I think some of the recent price weakness is perhaps overdone, so there's an opportunity for it to run in the short term, but I'd be selling into that from a longer term investor perspective. I don't think that this is an asset I'd want to be holding over a 5 to 10 year period, and that's really my judgment on their ability to generate compound earnings growth, which I think is well below the average industrial business out there.
Pete, your view?
Yes, I think at Anchor Capital in our model portfolio, we haven't had it there for a long time. So it's not a buy. It's not something, if I was to put together a personal 10-share portfolio, it certainly wouldn't be part of it. It does have an attraction for somebody who's looking for a high dividend yield. 7% is about as high as it gets for a quality company. So that is an attractive stream. And they have committed to a continual increase in the dividend of 5 to 15%. That could come under threat if the worst case happens with a lot of the factors that we're talking about. But ultimately, so you're going to get 7%, you're going to get a 7% dividend growing, and that's attractive for some. But I think that you could have a bounce in earnings because there's a lot of currency type factors at the moment. But that's unlikely to grow, the earnings are unlikely to grow anywhere near 10% per annum on a compound basis. So I think the best way to describe it is, as Sean said, a bond with some growth. And we say a bond because you're getting a yield out of it. So for a dividend investor, you could justify it being in the portfolio. But to get a fundamental all-in return from a share portfolio, we wouldn't have it in.
Do join us next time again when we talk more stocks.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.